Hello and welcome to our latest LinkedIn Live event. And I think it's the second in our series of these in 15 minutes webinars. And today's topic is something that we've covered before, just before Christmas time, but it remains something often overlooked, often misunderstood, and truthfully often avoided entirely by accountants. And that's why we're here today, to hopefully talk to an audience full of accountants who want to know about this stuff. In our first session on hedge accounting, that's the theme for today, by the way, we looked into some of the details about who should use this special accounting treatment, the benefits, some of the costs, and whether it's as difficult as people say it might be. In today's session, I am once again delighted to be joined by our subject matter expert, Craig Haymaker, a certified public accountant and managing director at Eris Innovations. Craig has more years experience in this stuff than we can shake a stick at, so we're truly well and truly in good hands today. And I'm your host, Harry Mills, director at Oku Markets, a UK-based currency management firm servicing SMEs, multinationals, and private clients. Craig, great to see you again. Your third event with us. Thanks. Welcome back.
That's right, Harry. Thanks for having me back. I appreciate it. I've got my peppermint button up and a gullet full of coffee, so I'm ready to roll.
Excellent. We like to hear it. So we promised a 15-minute overview. We've wasted a minute already on the quick intro, or 45 seconds. So
Indeed.
Let's get into it. Last time you and I met and we did the first session on hedge accounting, we did touch on some important points, but our audience was left wanting just a little bit more. That's per the messages I got on it, right? Hence today's session. So why don't we go back in time? Let's start with the basics. What's the problem that we're addressing, and why would a company care?
Of course. No, it's a fair question to ask, considering the perception is that it's this challenging nut to crack. Now, the problem is this. We're hedging and using derivatives because we have some foreign currency risk exposure, right?
Mm-hmm.
That exposure is causing volatility from an economic perspective, cash flow perspective, or what have you. So we go ahead and hedge that risk. Great. Now the accountants take over.
Yep.
And what the accountants will say is, okay, you have a derivative, and that derivative must be marked to market every reporting period, be it monthly, quarterly, what have you. And that mark to market amount can swing violently because the value of that derivative is going to fluctuate based on the underlying market that it's serving.
Yep.
Well, that can cause earnings volatility. Well, hedge accounting seeks to mitigate that earnings volatility by timing the offset of cash flows or value changes with the risk it's hedging. So that's the problem that it's trying to solve, is really financial statement presentation and financial statement volatility for end users.
Okay, so a business has an underlying currency exposure. They enter some derivatives, forward contracts, options, whatever it might be, to mitigate the FX risk. And by doing so, that creates another risk, an accounting risk, which is potential for earnings volatility, right? Is that
Exactly right. Exactly right. In some respects, you're exchanging one source of volatility for another if you just simply apply hedging without the hedge accounting aspect.
Got it. So I also asked, why would a company care? So just going back to the example, I've got some exposures, I've got some cash flows coming up. Maybe I'm buying a big piece of machinery or something. I've entered a forward contract to hedge against that. There should be a natural offset. That's the whole point. Mm-hmm. Why do I care about the accounting risk? What's the implications to me? Why am I bothered?
Right. The implication is that you've done one step to mitigate your risk, but not all of the steps, right? You're not showing key stakeholders that you're being a good steward of their capital by conveying that risk mitigation and earnings volatility mitigation across your financial statements. It becomes a presentation issue that you're not taking credit for your risk management activities.
Okay, and that's the stakeholders. So if anybody is looking at any kind of M&A activity, any kind of exit, anything to do with that, this is going to be quite important to show suitors or just any stakeholders, creditors, anybody.
Lenders too, yeah, creditors,
yeah,
right. Yeah.
That you're running your business efficiently and you're on top of these risks.
That's right. Yeah.
Cool. Good stuff. So as I said, it sounds like the act of currency risk mitigation produces another risk, and that can have real world consequences. We've just talked about the stakeholders and the perception of the business. What other consequences can this accounting risk, if left untreated, what other consequences can that have on a business? Let's say we've got this earnings volatility caused by these derivatives. What else can that do?
Yeah. Well, let's take a quick step back, shall we? When we think about hedge accounting, from an accountant's perspective, there are three kinds. cash flow hedge accounting, fair value hedge accounting, and net investment hedging as well. So
Okay.
cash flow, probably the most common, right? We think about transaction risk related to foreign purchases in foreign countries. I'm buying widgets from China. On the fair value side, maybe I have a foreign currency denominated bond in an
Hmm.
investment portfolio. Now, the net investment hedging is interesting too, because that is, in every sense of the word, an accounting risk, right? So in that instance, I'm a parent company. I have a foreign currency denominated subsidiary. Every time I consolidate that subsidiary into my parent company financial statements, call it on a quarterly basis, I'm exposing myself to currency risk at spot and average rates across that period. And that can create meaningful translation risk that I think is often unaddressed and doesn't, quite frankly, receive enough airtime, in my opinion. So, just in summary, cash flow really speaks to that transaction risk, and the fair value and net investment really speak to that translation risk component.
And we had in our conversation ahead of this session a few days ago, last week, we spoke specifically about that often overlooked and underserved piece is the on the translation exposure. It's not particularly well treated, you said. What should businesses be looking out for? Who should be raising their hand about this stuff? Anybody with an overseas subsidiary, and how they know to ask the question?
Yeah, it certainly overseas subsidiaries, companies with meaningful exposure to other jurisdictions, to other countries and their local currencies. But the reason why I'm highlighting it is I think it's easy for traders and treasury departments to think about, oh, I'm buying all of these goods and services from this country, meaningful transaction risk. But it's often overlooked because I have these subsidiary operations, and this translation, this consolidation function is creating these sort of synthetic losses, these accounting risks that can have a meaningful impact. Let's walk through an example. I'm a euro based parent company with a sterling based subsidiary. Just by simply of an infusion of capital, call it 50 million in that subsidiary. If I do nothing else, as I'm consolidating that subsidiary into my euro based financials, right? So I'm selling sterling, buying euro,
Hmm.
um, a 2 cent change and call it 2 cent decrease. That's a $1 million hit,
Wow.
pure accounting risk translation.
And these are the sort of moves that we might see on a monthly basis. I mean,
Right.
markets are slightly boring right now. There's a real low volatility regime, but that's not going to last forever with central bank action this year and with record global elections due. So this is a real risk. So in your example, let's say an Irish company, we're a UK and Ireland sort of set up here. So an Irish business has a UK subsidiary, and they're basically reporting on their UK earnings back into Ireland. That translation could be even a 2 cent movement on a 50 mil piece, 50 mil size is a 1 million plus or minus.
Exactly. That's
Wow.
exactly right. And they'll say, hey, I've parked this money over here. The company isn't even operational, but that doesn't matter
Mm.
from an accounting perspective. They're still going to translate it at then spot rates to the reporting currency at that period in time. So, from a hedging perspective, it's important to consider that accounting risk as well, not just perhaps the more obvious transaction risks before you.
Of course. Now we didn't prepare for this question, but I'm going to throw it to you anyway because I know how experienced you are. How
Let's
would
have
a
it.
business? Sounds good. We're going to take a meander here. How would that business, that Irish company with the UK subsidiary or whatever it looks like, how would they go about hedging that specifically? I mean, of course, this isn't advice. You need to seek advice on this stuff, but broadly speaking, what's the mechanism?
Yes, thank you for qualifying that for me, Harry. You'll get me out of trouble. Uh, Often, what I see, especially for entities that are perhaps consolidating financial statements across subsidiaries into parent on a quarterly basis, is I'll see a non-deliverable forward contract, which is to say, I have exposure. I'm selling one currency, buying another. I believe in that example, right? We were selling sterling, buying euro, or maybe the other way. Forgive me. but instead of delivering on the currency, you're acquiring, you're really just taking the cash settlement, right? You're getting exposure to those currencies and taking cash as a way to offset a potential loss or adverse movement upon consolidation.
Okay, and presumably you can roll these forward as well. That's kind of how it works.
Exactly.
Okay, cool. Good stuff. Now, last time, thanks for that little meander. Now, last time out, I asked whether hedge accounting is hard, and we spent probably 20, 30 seconds. It was at the end of the session. So I think we need to delve a little bit deeper. Let's not get stuck in the weeds of the technicalities necessarily, but what's the honest answer? What are the pitfalls with hedge accounting from your experience, and where should people go for support?
Yeah, no, you bet. It's a great question, and I get it often. Not easily answered. And here's what I would say: I think the general perception is that it's hard, because there's a lack of understanding, and it truly is sort of a different language. It's a different language accounting wise, and even for financiers, struggle with the accounting implications as well. It sort of straddles both worlds, right? Accounting and finance. Um, but it does have that perception, and I would say a challenge is time. It's extra time. Consider it for every reporting period, maybe an additional 3 to 5 hours of work, and appreciating that for folks that want to step in and understand this world better and can understand it. And once they do have that understanding, they don't deem it immeasurably difficult. The problem is with that time piece. And they'll say, look, even if I understand it, I still want to outsource it because I'm not in the business of hedging.
Yeah.
This is a fraction of what I do and what my brain space can handle. So I'm going to outsource that work. That's typically what it entails. Other pitfalls, documentation is key. I think the authoritative bodies like here in the U.S., the Financial Accounting Standards Board, or internationally, you've got the International Financial Reporting Standards, or IASB, establishing guidance, and they have, believe it or not, made it easier for end users to adopt hedge accounting, but they've sort of front loaded a lot of the work and put it on the documentation piece, and that can be a real challenge for folks as well as they seek to adopt this preferential accounting treatment. So it's things like that that are usually good to outsource.
And very quickly, what are we documenting? Because I know you have to be able to evidence hedge effectiveness, right? And you have to be able to evidence when you're undertaking a derivative contract, you have to be able to link that to a future cash flow or an exposure, or maybe it's not a cash flow, maybe it's the translation. So you have to be able to link those things, right? Is that what we're documenting here?
That is. So, just taking that one step further, it's typically these things. It's you're documenting the hedged risk management objective. You're describing the nature of the hedge between the hedging instrument and the items being hedged, or your risk exposures, going into detail so that it's crystal clear what and how much is being hedged. And then, as you astutely pointed out, the methods for assessing effectiveness, or really qualitatively asserting that it's effective and why you deem it effective, right? So you're speaking to the economic relationship as well. And then lastly, the financial statement impacts that a reader of that document could expect to see and appreciate by virtue of the hedge accounting relationship. It's sort of all of those things, but it's not a set it and forget it. You have to revisit your documentation, especially if the hedge ratio changes over time. You sort of need to reconstitute and address any changes in facts and circumstances surrounding the hedge. So it's been made more qualitative, but it does still take time.
Okay. So it sounds like there's a little bit of work to do, but with the right process and a bit of time, maybe with some external guidance, you can get this stuff done. We shouldn't forget the payoff for this is that you're not going to have that earnings volatility, which can have all sorts of consequences on your credit rating, on your stakeholder perception, maybe even on your tax liability. Speak to a tax advisor. But if you've got an extra 3 million quid of profits that aren't really there, then that presumably presents an issue.
Financial covenants, debt to equity ratios, return on equity, and things of this nature that are crucial for lenders as they evaluate solvency. Nothing to be trifled with.
So there's a lot there. We've just gone on to 15 minutes, so we've covered everything, Craig. So it is time to close the session. Thanks very much for attending. Thanks to Craig Haymaker, my esteemed guest panelist, for your expert insights. Hopefully if you joined today, you found it useful. If you'd like to have a chat about your business currency management, reach out to me, harry@arcumarkets.com. Give me a DM on LinkedIn. If you want to ask a question about hedge accounting, send a message to Craig, and he will certainly point you in the right direction as best he can. Our next webinar is in April, so look out for that. Craig, thanks so much. I'm sure we'll get loads more questions again, like last time. We'll see you next time.
Appreciate it, Harry. Thanks so much.
Cool. Take care. Bye-bye.